Welcome to the Book MBA channel. Today, we're embarking on a journey to decode the core investment philosophy of arguably the greatest investor of all time, Warren Buffett. While there isn't a single official book titled The Investment Principles of Warren Buffett, his prolific writings, annual letters to shareholders, interviews, and the insightful analyses by countless financial minds like Robert Hagstrom, Lawrence Cunningham, and Mary Buffett have meticulously documented his unique approach. This isn't just about buying stocks, it's about a profound understanding of business, value, and human behavior. Get ready to transform your investment mindset, because what you're about to hear are the bedrock principles that have built Berkshire Hathaway into a colossus. The foundation: business acumen over market acumen. Buffett's first principle, and arguably the most crucial, is that investing is simply owning a piece of a business. He approaches every stock purchase as if he were buying the entire company. This immediately shifts the focus from volatile stock prices to the underlying health and future prospects of the enterprise. Invest in what you understand. The circle of competence. Buffett famously states, "Never invest in a business you cannot understand." He defines his circle of competence and rigorously sticks within it. This means avoiding trendy industries, complex technologies, or anything with business models that are opaque to him. If he can't clearly articulate how a company makes money and why it will continue to do so, he doesn't invest. This eliminates countless potential investments, but drastically reduces risk and ensures deep understanding. Focus on intrinsic value, not market price. For Buffett, the market price of a stock is often irrelevant in the short term. What matters is the company's intrinsic value, the present value of its future cash flows. He dedicates significant time to analyzing financial statements, understanding cash flow generation, and projecting future earnings. He views market fluctuations as opportunities. A falling price for a good business means a chance to buy at a discount, while a rising price might indicate it's time to hold or sell. Think long-term compounding is magic. This is the cornerstone of Buffett's success. He doesn't trade, he invests for decades. His wealth is a testament to the power of compounding returns over an extraordinarily long period. He buys a great business and then he waits, letting the power of reinvested earnings and exponential growth work their magic. Short-term market noise is ignored. Embrace market volatility. This famous adage encapsulates his counterintuitive approach. When the market is euphoric and prices are high, Buffett is cautious. When fear reigns and good companies are beaten down, he becomes aggressive, buying when others are selling. This allows him to acquire quality assets at significant discounts. The moat. The power of competitive advantage. Buffett is obsessed with moats, durable competitive advantages that protect a business from rivals and ensure long-term profitability. Strong brands and customer loyalty. Companies like Coca-Cola or See's Candies benefit from powerful brands that create immense customer loyalty and allow for pricing power. People will pay a premium for a trusted product. Network effects. Businesses where the value increases as more people use them. Cost advantages. Companies that can produce goods or services at a lower cost than competitors, giving them a significant edge. Think of efficient manufacturing or distribution. Patents and proprietary technology. Legal protections or unique technological advantages that are difficult to replicate. High switching costs. Industries where it's difficult or costly for customers to switch from one provider to another. Regulatory/government protection. Industries with licenses or regulations that limit competition. The management factor, integrity and competence. Buffett places immense trust in the management teams of the companies he invests in or acquires. Look for honest and capable management. He prioritizes integrity, common sense, and a focus on shareholder value. He wants managers who treat shareholder money as if it were their own. Decentralized approach. When Berkshire Hathaway acquires a company, Buffett largely leaves the existing management in place, giving them autonomy to run the business. He buys great businesses and trusts great people. Shareholder-oriented management. He prefers management teams that communicate clearly, are transparent about challenges, and resist financial engineering or excessive executive compensation. The valuation discipline. Buying right. Even a great business can be a bad investment if bought at too high a price. Demand a margin of safety. This is crucial. He wants to buy a business for significantly less than its intrinsic value. This margin of safety provides a cushion against unforeseen problems or errors in calculation. It protects against permanent loss of capital. Focus on free cash flow. He values businesses based on the cash they generate after all expenses and reinvestments needed to maintain the business. This owner earnings is what truly matters. Understand return on capital. He looks for companies that can generate high returns on the capital they employ, indicating efficient use of resources. Avoid overpaying. He's famous for walking away from deals, even appealing ones, if the price isn't right. Patience is key. Don't be afraid of boring businesses. Often, The most attractive investments are in mundane, predictable industries, not the flashy tech darlings. The behavioral edge, mastering yourself. Buffett's investing success is deeply intertwined with his psychological discipline. Master your emotions. Fear and greed are the enemies of rational investing. Buffett remains calm when others panic and acts decisively when others are paralyzed by fear. Ignore the crowd and the media noise. He doesn't follow market trends or listen to day-to-day financial commentary. He focuses on fundamental analysis and his own independent judgment. Maintain an inner scorecard. He measures his success by his own standards and principles, not by what others think or by short-term market performance. This allows him to stick to his strategy regardless of external pressure. The importance of patience. Again, patience is paramount. He waits for the right opportunities, and once invested, he lets the power of time and compounding do the heavy lifting. Humility in success and failure. He acknowledges the role of luck and is quick to admit mistakes, learning from them rather than letting ego get in the way. Rationality over intelligence. He emphasizes that rational decision-making is more important than raw IQ in investing. Emotional control and common sense triumph over complex formulas. Practical applications and broader life lessons. Beyond the core investment principles, Buffett's approach yields broader life lessons. Frugality and living below your means. Despite his immense wealth, Buffett lives a remarkably modest life, demonstrating that true wealth is about freedom, not ostentatious consumption. Continuous learning through reading. He dedicates a significant portion of his day to reading, believing that knowledge compounds just like money. Invest in yourself. The best investment you can make is in your own education, skills, and health. Choose your associates wisely. He emphasizes the importance of surrounding yourself with people you admire and who elevate you. Simplicity is genius. His investment philosophy isn't complicated, but it requires profound discipline and consistent application. Long-term thinking extends beyond investing. This mindset applies to career, relationships, and personal goals. Conclusion: the investment principles of Warren Buffett are not a secret formula or a magic trick. They are a coherent, time-tested philosophy rooted in fundamental business analysis, psychological discipline, and a deep appreciation for the power of compounding. By treating stocks as ownership stakes in real businesses, focusing on intrinsic value, demanding a margin of safety, and cultivating unwavering patience, Buffett has demonstrated that extraordinary wealth can be built not through daring gambles, but through reasoned, principled, and long-term investing. It's about understanding why a business truly excels, protecting your capital, and letting time do the heavy lifting. These principles are accessible to anyone willing to put in the intellectual work and exercise the emotional discipline. They are the blueprint for building lasting financial security and, ultimately, a richer life. Thank you for joining the Book MBA for this deep dive into the investment principles of Warren Buffett. If you found these insights valuable, please give this video a thumbs up, subscribe to our channel, and share your favorite Buffett principle in the comments below.